Welcome, everyone. The webinar is just about ready to start. Well, thank you for joining us. Today is Friday, July 10th, and today's webinar is Long-Term Care Insurance in Plain English, presented by Scott A. Olson, CLTC, co-founder of ltcshop.com. You'll learn tips that will help you understand and compare the most important features in long-term care insurance policies. Today's webinar will last about 35 minutes, followed by 10 to 15 minutes for the question and answer session. All attendees will be in listen-only mode throughout the webinar. During the webinar, please email your questions directly to scott@ltcshop.com. After the presentation, Scott will answer as many questions as time allows. Any questions not answered during the webinar will be answered personally by Scott via email within 2 business days. Scott Olson is the author of Simple LTC Solution: How to Protect Your Life Savings with a Long-Term Care Partnership Program. It is available on Amazon.com. With over 25 years of experience specializing in long-term care insurance, Scott is a sought-after expert. He has been quoted in leading publications including AARP Magazine, Kiplinger's, The New York Times, U.S. News and World Report, Business Week, and Smart Money Magazine. Scott is an expert on the 5 types of insurance policies that can help pay for long-term care, including traditional long-term care insurance, long-term care partnership policies, hybrid life insurance policies, hybrid annuities, and recovery care policies. Since 1995, Scott has helped consumers across the country obtain quality long-term care insurance policies. He is licensed to sell long-term care insurance in all 50 states, including the District of Columbia. Scott was born and raised in New Jersey and attended Rutgers University. He began his insurance career in Florida and lived there for 14 years. Scott and his wife Carolyn reside in Camino Island, Washington, along with their sons, 2 dogs, and 3 cats. Let's get started.
Thank you, Carolyn, for your kind introduction, and thank you to everyone who's attending today's webinar. I'm Scott Olson, and it's an honor for me to share this information with you today. Now, give me a quick second here, and I'll turn on the camera, and so I can wave hello to everyone. And there we are. Okay, hello. Thank you for joining me. A quick warning about today's topic. We do lots of different webinars, lots of different topics. Of all the topics that we do, this is probably the most dry. It's probably the driest of all the topics, but it's also probably the most educational and the most important. If you've ever tried to compare long-term care insurance policies, or if just to understand a policy, you understand how difficult it can be. So we're going to clear all that up for you today, all right? You can see there's lots of terms behind me on my board. We're going to go over all these and explain them to you. So let me turn the camera off, and then we'll get back. We'll get back to the slides, and we'll go through each term. So, all right, here we go. Good. Okay, so how do long-term care insurance policies work, and how can you easily compare policies? Fortunately, you can, and that's what we help our clients do. We have software that allows us to compare policies side by side, and we compare the leading long-term care insurance policies for each client. Now, if we take a look at the left-hand column here, all right, and we magnify that, you can see some of the terms that are used to describe the different benefits and features that are in long-term care insurance policies. And we're going to go through each of those today so that by the end of the webinar today, you'll be better able to understand the different policies you're looking at and also better able to compare the policies. Okay. The first term we'll discuss today is tax qualified. When reviewing a long-term care premium comparison, the very first line will tell you if the policy is tax qualified. If a long-term care insurance policy is tax qualified, it means the policy includes all the consumer protections recommended by the federal government. So where did the term tax qualified come from? Well, when the federal government created these protections for policyholders, they also authorized special tax treatment for all policies that meet these guidelines. Tax-qualified policies have tax-free benefits and tax-deductible premiums. 100% of reimbursed benefits are tax-free. The benefits are even tax-free when the premiums are paid with pre-tax dollars. Now, there are 5 ways to reduce your taxes with long-term care insurance. The first is with a health savings account. The second is for people who are self-employed. There's a special tax deduction for long-term care insurance just for being self-employed. Businesses and business owners can also have special tax deductions as business expenses for employees, or maybe only for key employees, or even for maybe co-owners and things like that. Anyone who itemizes their tax deductions can include long-term care insurance as part of their itemized medical expenses. And lastly, 31 states have tax deductions or tax credits for long-term care insurance premiums. Now, I'm not a tax advisor, so please consult your tax professional about your unique situation. The next term we'll look at is underwriting class. When reviewing a long-term care premium comparison, usually the second line down will be the underwriting class. Your current health and your health history will determine what your long-term care insurance policy will cost. The healthier you are when you apply for a policy, the lower your premium will be. Now, there are 4 commonly used underwriting classes: preferred, standard, class 1, and class 2. Someone with a preferred rating pays the lowest premiums. Standard rates are usually about 20% higher. Class 1 rates are about 50% higher, and class 2 rates are about 80% higher than preferred rates. What's the lesson? Don't wait until you have a lot of health problems to apply for long-term care insurance. Now, here's the good news. There are over 99 health conditions that can qualify for the preferred underwriting class. Just go to ltcshop.com/99 to see the current list. Lastly, there are no standardized terms when describing or naming the underwriting classes. Each company uses different names for each of their underwriting classes. For example, most companies will use preferred to describe their best rate class, but there's actually 1 or 2 companies that use the word preferred to describe their worst rate class. So don't be confused by the different terminology. Your agent will match up the correct underwriting class based upon your unique health history. The next phrase we'll look at is facility daily benefit. That means how much can the policy pay for each day of care in a facility? This decision is made when you purchase the policy, not when you need care. You choose how much you want your facility daily benefit to be. In this example, it's $170. The higher the facility daily benefit, the higher your premium. The lower your facility daily benefit, the lower your premium. At the time of care, if your care costs more than the facility daily benefit, then you'll need to make up the difference using your own income or assets. The next term we'll look at is facility benefit period. And that means how long can your policy benefits last? Now, this is usually expressed in a number of years. For example, in this case, we're looking at a facility benefit period of 5 years. Now, you can choose more than that or less than that. It's totally up to you, and it's a decision you make at the time you purchase your policy. The longer the facility benefit period, the higher the premium. The shorter the facility benefit period, the lower the premium. The next term we'll look at is facility elimination period. And that means it's the number of days of care you receive before the policy benefits start. Now, most policies have a 90-day facility elimination period, but you could choose a shorter elimination period for a higher premium, or you could choose a longer elimination period for a lower premium. That's totally up to you. Okay, so we've looked at 3 different topics regarding the facility benefits in every long-term care insurance policy. The first topic, facility daily benefit, that answers the question, how much can the policy pay for each day of care in a facility? The facility benefit period answers the question, how long can my policy benefits last? And the third topic, facility elimination period, answers the question, when will the benefits kick in? The next term we'll look at is home care daily benefit. What is the home care daily benefit? It's how much the policy can pay for each day of care at home. And it's usually expressed as either a percentage or a dollar amount. Now let's take a look at one example on one of the premium comparison worksheets. You can see in this example it says home care daily benefit 100%. Now the first thing people think of when they see that is that the policy will cover the full cost of home care regardless of the actual cost of care. That's not what that means. What it means by 100% is that the home care daily benefit is 100% of the facility daily benefit. I'll say that again. In this example, it means that the home care daily benefit is 100% of the facility daily benefit. The next term we'll look at is home care benefit period, pooled. Now the home care benefit period means how long can the policy pay benefits at home? When would the policy run out of home care benefits? How long can the home care benefits last? And if we look at a premium comparison worksheet, we can see right here that it says home care benefit period pooled. Well, what the heck does pooled mean? It's a long story about how policies used to work 25 years ago, but let me just say this. The best way to understand it is that 100% of the facility benefit period can be used for care at home. So the pooled basically means no matter how you need care, whether you need some care in a facility and some at home, or if you need all your care at home, or you need all your care in a facility, it doesn't matter. You're free to use up the facility benefit period, all of it at home or all of it in facility, however you might need it. The next term we'll look at is monthly home care. Monthly home care means that your policy calculates your home care benefit by the month, not by the day. Some policies calculate your home care benefit on a daily basis, others on a monthly basis. There's usually not a significant difference between these two types of policies. $200 per day is about the same as $6,000 per month. However, if your daily home care costs fluctuate significantly, then a policy that calculates a monthly benefit will help minimize your out-of-pocket expenses. Now, if a policy calculates your home care benefit on a monthly basis, it'll say monthly right up here, monthly home care, monthly. If it calculates the benefits on a daily basis, then it'll say daily right there instead of monthly. So looking at the different benefit amounts, the home care daily benefit explains how much the policy will pay for each day of care at home, and the home care benefit period explains how long the policy benefits can be paid for care you receive at home. The next term we'll look at is pool of money. The pool of money is calculated as follows. If your policy has a daily benefit, take the daily benefit, multiply it by 365, and then multiply that by the number of years in the benefit period. If your policy has a monthly benefit, take the monthly benefit, multiply it by 12, and then multiply that by the number of years in the benefit period. Let's take a look at an example from the premium comparison worksheet. This policy has a $300,000 pool of money. That's calculated by taking the $5,000 monthly benefit, multiplying it by 12, multiplying that by the 5 years in the benefit period, and that equals $300,000. Why is this important? Because your policy can pay benefits longer than the benefit period. If you've not exhausted your pool of money, you can continue to receive benefits from your policy, even beyond the benefit period. For example, if you only used $2,500 per month in this case, this $300,000 pool of money would last for 10 years. The next phrase we'll look at is policy type. There are two types of policies, facility only and comprehensive. A facility-only policy does not pay any benefits for care at home. 99% of the policies purchased today are comprehensive policies, paying benefits for facility care plus home care. Most insurance companies only sell comprehensive policies today. You should assume that every policy we compare for you is a comprehensive policy, even if it doesn't specifically state that on the premium comparison worksheet. If a policy is a facility-only policy, it will clearly state that under policy type. It will also show that the home care daily benefit is $0 and that the home care benefit period is 0 years. The next term we'll look at is payment option. That means how many years will you pay your premiums? Now, most policies have a lifetime payment option. That means you pay your premiums until you begin receiving benefits from your policy. But other policies have a single premium option. You pay one single lump sum premium. Other policies, you can choose a 10-year pay policy, where you pay your premiums for just 10 years and you're done after 10 years. That can be a great choice for business owners who want to take advantage of a tax deduction, or it's also a good choice for people who want to pay their long-term care insurance up during their peak earning years and not have to pay any premiums in retirement. But most policies are lifetime. That means you pay your premiums until you begin to receive benefits from your policy. The next term we'll look at is partnership plan. The LTC partnership programs answer the question, what happens if my long-term care insurance runs out of benefits? Or even more specifically, how much long-term care insurance should I buy? Now, if a policy is a LTC partnership plan, that means that your assets can be protected from Medicaid even if you exhaust all the benefits in your policy. Now, it's a very complex subject, so because of that, we've dedicated a huge section to our website just on this one topic. So go to ltcshop.com, click on LTC Partnership, then on the map, click on your state to learn about your state-specific program. We've also created a webinar just on this one topic. So go to ltcshop.com/webinar to find out when we're presenting that webinar next. The next phrase we'll look at is shared benefit. A few minutes ago, we talked about the pool of money. The shared benefit is a feature that allows couples to share each other's pools of money. Now, there are two types of shared benefit: 2 pools of money and 3 pools of money. Let's take a look at the 2 pools of money first. If your policy has this shared benefit, it will say yes on the premium comparison worksheet. Now, I'll explain how it works using 2 glasses of water. We put red food coloring in each glass to make it easier for you to see. Spouse A has one pool of money. Spouse B has one pool of money. Let's suppose spouse A needs care. Spouse A will draw benefits from the pool of money. If spouse A uses the entire pool of money, spouse A will then begin to draw benefit from spouse B's pool of money. Now, most policies require that some benefits be reserved for spouse B. In other words, spouse A can't use all of spouse B's policy. Now let's take a look at the three pools of money. If a policy has the shared benefit with three pools of money, the premium comparison worksheet will say third pool. Then down at the bottom, it will state shared third pool and the amount of benefits in that shared third pool. I'll explain how it works using 3 glasses of water this time. Spouse A has one pool of money, spouse B has one pool of money, and there's a third pool of money that is shared between the two of them. Let's suppose spouse A needs care first. Spouse A will draw benefits from the pool of money. If spouse A uses up the entire pool of money, then spouse A will draw benefits from the shared third pool. Spouse A cannot use any of spouse B's pool. Spouse B's pool is reserved for spouse B only. The next term we'll look at is inflation protection. When a relative of mine needed home care in 1999, we paid his aides $10 per hour. Today, the average hourly rate for a home health aide is over $23 per hour. How much will a home health aide cost 20 years from now? Inflation protection answers the question, how will the policy benefits grow over time in order to keep pace with the increasing cost of care? Each quote we provide shows the inflation protection that we included in that quote. Now, there are a lot of choices for inflation protection in the long-term care policies that are offered today, and it can get very confusing. But there's 3 simple questions you can ask when comparing policies in order to pick the policy that's right for you. The first question you need to ask is, how much? How much will the policy benefits grow each year? Will it be 1%, 2%, 3, 4, 5% per year? And will the growth be compounded growth, or will it be simple growth? Also, some policies don't use a certain percentage. They'll use an index like the Consumer Price Index. The second question you need to ask is, do the increases stop at some point? Now, most policies have inflation protection that grows every year for as long as you live. I'll say that again because it's really important. Most long-term care insurance policies have inflation protection that grows your benefits every year for as long as you live. But there are some policies that have a point at which the inflation protection stops growing the benefits. It might be at age 75, or it might be after 20 years. So it's very important that you ask this question so that you know what you're buying and to make sure you're comfortable with what you're buying. The third question you need to ask is about premium increases. Do the premiums go up as the benefits go up? Most inflation protection features have no planned premium increases. I'll say that again. Most policies that have inflation protection built into it have no planned premium increases. The growth each year is already built into that premium. However, there are some policies that have planned premium increases, and as the benefits go up, the premiums go up. Now, here are some clues to help you to determine which type of policy you're looking at. If you see terms like purchase option or might be abbreviated as FPO or GPO. Or if you see a term called step rated or CPI offer, that means you're looking at a policy where the premium will go up as the benefits go up. So these are the 3 questions you need to ask about the inflation protection that's being quoted for you. The first question, how much will the benefits grow by each year? Will the growth stop at some point? Will the increases in the benefits stop at some point? And thirdly, probably most importantly, is will the growth in the benefits each year make the premium increase each year? The next phrase we'll discuss is 0-day home care elimination period. Earlier, we talked about the facility elimination period. That's the number of days of qualified care before the policy benefits kick in. With most policies, the facility elimination period and the home care elimination period are the same. For example, 90 days of facility care or 90 days of home care would satisfy the elimination period. Some policies, however, have no elimination period for care at home. That's usually abbreviated as it is right here, where it says 0-day HC elim period, or in other words, 0-day home care elimination period. It says yes. Now, most policies don't have this feature, but some do. The next phrase we'll look at is non-forfeiture. Non-forfeiture means that if you stop paying your premium, you don't lose your policy. It's called non-forfeiture because you're not forfeiting your policy. Now, there are 2 kinds of non-forfeiture benefits in long-term care insurance policies. The first kind of non-forfeiture benefit is called shortened benefit period. It means that if you cancel or lapse your policy after you've had it for at least 3 years, you'll be given a small paid-up policy in its place. The small paid-up policy will have a pool of money that's equal to the sum of premiums you paid. That's where they come up with shortened benefit period. It's a smaller pool of money. And that smaller pool of money is equal to the amount of premiums that you have paid. The daily benefit remains the same. Even if you had an inflation protection in the policy, the daily benefit will remain the same. It will not grow. Now, insurance regulations require that this non-forfeiture benefit be offered to every person applying for long-term care insurance. It's actually a good idea. However, most people do not add this benefit to their policies because it does add to the cost of the policy. The second type of non-forfeiture benefit is called contingent. That's the contingent non-forfeiture. It means that if you were to receive a substantial premium increase approved by your state's insurance commissioner, you have the right to stop paying premiums on your long-term care policy and have your policy converted to a paid-up policy. And the paid-up policy would have a pool of money equal to the sum of premiums you'd paid. Now, this feature is included automatically in every long-term care policy today at no extra cost, and you can see it noted on the premium comparison worksheet where it says non-forfeiture, and there on the far right it says contingent. The next phrase we'll look at is return of premium. Return of premium is a feature in some long-term care policies where the premium is returned to your heirs upon your death. Now, there are many different types. Most of them only return the premium minus whatever long-term care benefits you received from the policy. The next phrase is restoration of benefit. It means that your policy's pool of money is fully restored 181 days after you've stopped qualifying for benefits. An example of this might be an injury from a fall. You need care for several months, but then you fully recover. After recovering, the benefits you received from the policy are put back into the policy. Your pool of money is fully restored. The next phrase we'll look at is modal factor. What the heck does that mean? Well, modal factor means how often do you pay your premium. And on the premium comparison worksheet, it'll say modal factor and what factor was included for that particular quote. There are 4 choices. You can pay your premium either annually, semi-annually, quarterly, or monthly. Annual premiums are usually the cheapest. There's usually a discount for paying once per year. If you pay on a monthly basis, it typically has to be done on an automatic withdrawal or like an electronic payment. And that's what the PAC or EFT stands for. PAC is pre-authorized check. EFT stands for electronic funds transfer. The next phrase we'll look at is gender. Most, not all, but most long-term care insurance policies have different rates for each gender. If you think about it, long-term care insurance is kind of like the opposite of life insurance. For life insurance, men pay higher rates because of a shorter life expectancy. For long-term care insurance, men usually pay lower rates for the same reason, a shorter life expectancy. Women live longer than men, and the inflation protection in the policy grows the benefits higher and higher year after year. That's why women usually pay higher rates than men for long-term care insurance. Let's look at the next phrase, waiver of premium, HC. HC is short for home care. With most long-term care insurance policies, when you begin to receive benefits from the policy, your premium stops. That's called waiver of premium. This phrase, waiver of premium HC, followed by a yes, means that the premium is waived for care at home also, not just for facility care. There are a few policies that only waive the premium for facility care, but most policies today will waive the premium when you're receiving care at home also. The next phrase we'll look at is assisted living percentage. In other words, what percentage of the facility daily benefit is payable for care received in an assisted living facility? Assisted living facilities have become very popular. Every long-term care insurance policy available for sale today includes coverage for assisted living facilities. Most policies will pay 100% of the benefits for care in assisted living facilities. Some policies, however, will pay a lower percentage of the benefits, maybe 50% or 75% if you're in an assisted living facility. But most policies will pay 100% of the benefits for care received in an assisted living facility. The last phrase we'll look at before we get to the Q&A is cash benefit, or sometimes called the cash alternative benefit. It's a feature that's in some long-term care insurance policies that allows the policy benefits to be used any way you want. In this example here, we've got a policy that has a cash benefit that's equal to 40% of the monthly benefit. And a real life example, a commonly used example, might be to pay a relative. Typically, long-term care insurance policies won't pay a relative to provide care for you. In this case, it would. You could use the cash benefit to pay a relative to care for you. Or another example might be if there's some robots developed in the future, something like that. Well, even if that's not covered under the policy, you could use the cash benefit to pay for something like that. Okay, and it's time for the Q&A. We usually have at least 15 questions submitted each webinar, oftentimes more than that. I won't be able to answer all of them right now in the next few minutes, but I do want to answer every question. So please email your questions to me at, here it is, scott@ltcshop.com. That's scott@ltcshop.com. That's my personal email address. If I don't answer your question in the next few minutes, I promise I will answer via email within the next 2 business days. Okay? Okay, the first question is this. It says, what net worth should someone have in order to self-insure and not need to own long-term care insurance? That's a great question, and certainly it varies depending upon if you're single or married. That's a big difference. But also, it's really not about net worth. Okay, you don't pay your bills with your assets, and if you start to deplete your assets and liquidate your assets to pay for care, that has a negative effect, especially if you're married, on the healthy spouse. If your assets are going down every year, year after year after year, that's decreasing how much your assets would normally be generating in income. Okay. What you really should be asking is not what net worth is adequate in order to self-insure. You should be asking how much income should I have in order to be able to comfortably self-insure. Now, but here's the key. If you're going to be paying for the cost of care from your income, you still have to cover all your other expenses. Especially if you're married, you've got most, if not all, of the other expenses. So some of your current living expenses can be reallocated to pay for your long-term care, but there's some expenses that can't be reallocated to pay for your care. So don't do the numbers by looking at your net worth. Crunch the numbers by looking at your income. And unless you're reinvesting $100,000 a year, well, you probably can't comfortably self-insure, especially if you're married. Okay, the next question reads, I use marijuana for recreational purposes. Marijuana is legal in my state. Will that disqualify me for long-term care insurance? The answer to that question is probably not. Okay, it depends. It's going to depend upon other aspects of your health history. It'll depend upon how often you smoke marijuana recreationally, and also it also depends upon if you have a recent history of drug abuse or alcohol abuse, things like that. So recreational marijuana use is not in and of itself something that would cause you to be declined. It's going to depend upon other aspects of your lifestyle and your health history. Okay, next question reads, are there any regulations to protect us from future rate increases? And the answer to that question is yes. Okay, and the regulations vary by state. So what state you're a resident of when you buy your policy, that's the state that you'll have regulations to protect you from rate increases, or maybe not protect you. Some states are better than others. The most important thing is to understand that 41 states have what's called the rate stability regulation. Okay, and go to our website, ltcshop.com, click on rate increases, then click on your state in the map, and you can learn more about how the rate stability regulation works in your state. Now, even states that have not yet passed the rate stability regulation, most of those states, not all, but nearly all of them, still require that in order for there to be a rate increase, that the rate increase has to be justified, and it does have to be approved by the Department of Insurance. Okay, so there are regulations to help protect you from rate increases, but the biggest news really is, or the biggest advantage is that policies purchased today are priced much differently than the policies that were sold 15, 20 years ago. So the policies that were sold a long time ago had a lot of errors in their pricing. And so the assumptions that are being used today are much more conservative, use much more conservative assumptions, which is why policies purchased today cost more than older policies. Okay, the policies purchased today are priced in order to remain rate stable, not to have rate increases like the older policies did. Okay, great question. Thanks. Okay, the next question says, if I have a 3-year benefit period and I get Alzheimer's and use up all 3 years of benefits, can I buy another policy after I've used up the 3 years of benefits? Uh, Great question. This is a question we get quite often. And the answer is no, you would not be able to buy another policy. So, and the reason you wouldn't be able to buy another policy is that you'd be uninsurable. So, once you've been diagnosed with Alzheimer's, you can't buy another policy. Okay. So no, you would not be able to buy another policy. This is why it makes sense for many people to buy long-term care partnership policies. We didn't talk about it today, but sign up for our long-term care partnership webinar and learn more about how the long-term care partnership policies work, because a long-term care partnership policy can protect your assets even if the policy runs out of benefits. And we explain how that works in that webinar. Okay? Thanks a lot. Great question, though. Okay, the next question says, is there a discount if I pay my premium once per year? Great question, and the answer to that is yes. With most policies, with most long-term care policies, if you pay your premium once per year, you usually get a pretty big discount compared to if you paid your premium every month. So usually the discounts for paying once per year are 7 or 8%. Some companies maybe 5% or 6%, but it could be anywhere from a 5 to 8% savings if you pay your premium once per year. So great question. Thanks for asking that. And that is the last question that we can answer today. If I didn't answer your question, I will answer it via email. So please look for the answer to your question via email within the next 48 hours. Thanks again for attending, and we look forward to serving you. Thank you.